All right, stocks continued their bounce off the lows yesterday. The question now is, have we pulled back enough? Is the pullback done? Is this bounce suggesting, this continued bounce suggesting at least that we're ready to head back up towards new highs? How much, if we do continue to pull back, how much more and how long? Those are all things I look at as we look at these different charts and what the likelihood is of either bouncing or pulling back based on past precedent. So I'm going to break all that down with today's continued rally and see how that changes things as we filled in an early morning gap from this morning. And then today's trade is an interesting technical pattern that provides a speculative trade opportunity to the upside in a sector that's been really beaten up. So let's go ahead and get started. Today is Wednesday, May the 15th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's go ahead and get started and take a look at the S&P 500 here with the market forecast indicator. Now, before you get too hyped up about this little bounce we're having, keep in mind that we do have dark pink shading in a red line. So while I don't think that we're headed towards this kind of pullback, this isn't also the most bearish, this is the bearish pattern, right? This isn't the most bullish pattern out there. So don't get too worked up about this move to 2850. In fact, these lines right here that I've got drawn, these Fibonacci lines, they are the retracement of this move off of the last 1% pullback, right? So we've almost completely retraced that move, and you can see where next layers of support would be in terms of that retracement. We've almost retraced that move, but we haven't. We hit the 2800, which this red dotted line is the retracement, the 23% retracement of this intermediate rally, this black dotted line, right? This intermediate rally from low to high. That's there's lots of layers of support. We've looked at that before. That's an area we were watching, and I even mentioned before how uncomfortable people would be if we did pull back to what would be a measly 23%. I mean, that's pretty measly normally, but because we rallied so much for so long, and no one pulled up markets in turmoil images while we were rallying far longer than we should have, but they have pulled it on here when we haven't even we basically have just retraced 23%, which is the smallest Fibonacci level retracement level there is. So a little bit of perspective on this pullback and how bearish it is, but also a little bit of perspective on this bounce, right? So these blue lines are the retracement zones. So there's going to be there was some support during the pullback. Now there's going to be some resistance on any bounces back up. So keep in mind that you break back through 2900, now we're back going again. But until you break through 2900, look for any moves into this area between 2850 and 2900 to be to meet up with some resistance. As you can see, even on SPY, that's where a big volume node is in this 2900 area. It would be 290 on SPY. So it's not and down a little bit further into this 288 area. You can see that's where the top end of this volume zone for the past year is. So there's going to be some resistance in that area. It's not going to be barring a insanely bullish news announcement. It's probably not going to be a bullish move. It's significantly above 2900 anytime soon. Of course, anything can happen. The nice thing is that during these pullbacks, the last couple near-term peaks have been bearish near-term highs, which are on the blue line, highs between 50 and 80, so they never did get above 80, here or here. There's a peak right there. You can barely see it, but there's a peak right there with all that other color. So these last two peaks, and neither one of them got above 80, but they did both cross above 50. And if you look at their corresponding peaks here, so this level on the first one, and then down here to this jump on the second one, they've been progressively lower. So again, another reason why you break through 2900, you get up through the previous near-term peak. Unless you do, then we're probably going to hammer around some resistance here and potentially even continue to trade towards 2800 again, if not a little bit lower towards 2780, which is the low point of the last 1% pullback that we've had. But again, are we going to have this kind of low? Well, you notice the near-term line's not dropping the sharply low levels like it did during that initial drop there. So that's a good sign, and a good sign for the markets that we're not headed, at least according to the technicals, we're not headed towards this kind of pullback. We're still headed more towards this kind of pullback where the near-term line never did get below 20. It just might last a little longer than this one did because this intermediate pullback over here on the left came after only a couple of months of rallying, whereas this one, and a small gain, relatively speaking, you can see if I take a look here, you can see it was just a relatively small gain. What would it be from right around that area up to those highs? About 6% gain versus a 20% gain plus gain here during this rally that lasted 4 months. So that's why I think we might be a little bit longer during this pullback than this one. But the idea is still the same. It was just a Fibonacci retracement to the previous 1% low, which is the same thing here that we bounce off of eventually and move on. And when will we know that we are bouncing off and eventually moving on? When we get back up above 2,900, because that's the old near-term high point here. The moving average is there. The Fibonacci retracement zone is there. We would clear the retracement zone at that point. So getting back above 2,900 would be the sign that we are indeed making that run. So we're not there yet. We're still getting these bearish near-term highs, but we're not getting the bearish near-term lows. So it's a good sign that we're not going to falter or significantly break down. At least not yet, right? Anything can happen if anything comes out that changes investor sentiment. You can see from a technical perspective, where these Fibonacci lines are crossing. You notice they're towards the end of May, where the retracement lines are crossing the Fibonacci fans, the next level up. So we're looking at May, the end of May, that we could even come down to 2720 even if we were to continue to pull back to the next 1% low, which would be only a 38% retracement. And so I still expect weakness over the next week or two on the S&P 500, even if we bounce up for a little bit and then come back down and like double bottom around 2,800 over the next week or two on the S&P, if not break down further towards 2720 by the same time frame. So you take a look at the other indexes. Well, let's look at the Dow first. They all have the same dark pink shading red line, so they're all in the midst of a pullback right now. Like the S&P, the Dow's formed multiple bearish near-term highs. Now the question is this one going to be, and you can see where 26,000 would be the equivalent layer for a breakup above that for things to change for the Dow. The Nasdaq Composite, we're looking at just under 8,000, about 79.50, 60 area for that move. And then finally for the Russell 2000, which has been less bullish during this bounce, it's got the same pattern. But you notice the Russell 2000 has got this little bit of a bullish divergence going on here with higher lows in the near-term line with lower lows. So, again, I don't expect us to break out here and now take off for another 10% move to the upside or 5 to 10% move to the upside. I'm not looking for that, right? But I also see enough positive signs on the market forecast that we're not tanking either. As doom and gloom as it's been the last week and a half, as much as people expect, whatever headline's been causing this selling, other than the fact that we've just been extremely overbought, but whatever headlines we want to assign to the cause for this selling, the reality is it's just a retracement, and the selling hasn't been that bearish enough to suggest that we're going to really pile on here. There's still the technicals, at least on this indicator, suggest there's a good chance this support's going to hold, or a lot of these indicators are trading at. Maybe not today, maybe not tomorrow, but a good chance that eventually we'll bounce off of these support levels and then make our way up towards new higher highs again and get going on a new intermediate run. That's typically, again, 1 to 3 months, right? Once the intermediate line crosses back up above 50. All right, before we look at some other charts, I wanted to invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. That notifies you when our videos are posted on our channel. Also, hit the thumbs up icon down below. That tells me that you want us to do the video again tomorrow. Quick, easy way to give us feedback. Lets us know that you like these videos, that you want us to keep doing them. And then finally, number 3, comment down below on anything that you got out of the video today. Join our Daily Market Outlook email list. There's a link popping out in the top right corner of your screen up there. Click on that link to subscribe to our email list. Follow me on Twitter for more content in between videos from day to day. And join our Facebook community that we created, our Market Outlook Facebook community that we created. Alright, if you're watching our video on our blog post here, we look for 3 clicks on this page. Number 1, click on this heart. We'll open up this today's Market Outlook tweet. On Twitter, you can click on that like button there. Number 2, click on this image. It takes you to your Facebook page. And today's Market Outlook Facebook post, you can like that and share it as well. And then finally, 3, this likes the blog post on our community. And again, our community assigns points for things like that. So you can kind of get an idea of who's active in our community. Remember, you can also share our blog across any of those social platforms, as well as email with any of these buttons down here: LinkedIn, Facebook, Twitter. You can also sign up for our daily Market Outlook email list here. Very simple way to do that. And then finally, our calendar over here on the right, as well as a link to the Market Outlook forums here on marketscholars.com. You can see another link up here at the top that takes you straight to that forum. This is available for everybody. Our classes are available only for our premium subscribers, our class forums, but our Market Outlook forums are available for anybody that subscribes to our site for free. And you can do that by clicking on this image over here under Join Market Scholars. Alright, now let's take a look at the long-term charts. And again, for the second consecutive week, we're getting a long lower shadow on the actual weekly chart. We still got 2 days left, so we can still trade within the range of the lower shadow here this week. But again, another sign that we're not as bearish as it seems. We are in between the 50 and the 200-day moving averages. So unless we really get back up above this 2900, say like next week, then there's a good chance we'll trade towards the 200-day moving average, as we've seen before we do get that bounce up. That's the most likely scenario, since we haven't had that after the golden cross. We haven't had the retest of the 200, which is typical after golden crosses. You can see the Hakinyashi this week's candle. It's going to be very unlikely. I mean, we'd have to get above 2900 this week to get a long upper shadow. And then next week, you can see the open for next week's candle, because we open up so low this week, is the halfway mark between 289.79 up there, the open, and the close at 283.29. That's a 6.5 point difference. Cut that in half, 3.25 points. So you're looking at 283, 283.29 plus 3.25 points. That puts us at 286.54. And if you look at the where the Hakinyashi is now, 286.54 would put us right there. So the purple line is going to move down to there, and that's where we'd have to get above next week to get a transition candle that will lead to a bullish turnaround. So again, that could happen, but most likely we'll probably start to trade back into this area here down below for the rest of this week heading into next week, and potentially get another bearish Hakinyashi candle before the week after that, or last week of May, we get the transition candle that could lead to a bullish reversal pattern. That's kind of the expectation there. If we take a look at the 3 green arrow chart, you can see that we have one green arrow. The stochastics is always the first one, generally, to give you the green arrow when you get 3. You can see the green arrow, the stochastics came here first. Actually came with the MACD this time. And then, once you got the 3 red arrows here, the stochastics came first, then the MACD. The moving average can also come pretty darn quickly too, if you're just barely testing it. So in this case, the stochastics is turning up. We got the green arrow there. The MACD is not going to get you a green arrow anytime soon. You can see even the stochastics is turned up, but it hasn't crossed its moving average. The MACD has to cross its moving average before giving you a green arrow in its histogram, and it's still below 0. This still below 50. So we're not like I said, probably won't be bullish until you break above 2,900. That's probably what's going to take for the MACD to get back above zero, stochastics to get back above 50, and make our way into the upper half of those charts again. And remember also, too, for us to get going on a bullish trend, the 8-day would have to cross the 17. That's what gets the blue line down here on the MACD back above zero. And then the 8 and 17 would have to cross above 30. That usually comes after you get the green arrow on the histogram and the rise above zero on the blue line. You get the 8 and 17. That's kind of like your final layer of confirmation that we're starting the intermediate run again. Again, that's not going to happen with a move up, and you can even see, despite this little bounce to the 2850 level, we're still below the 8-day exponential moving average. So until we get back above that and start testing the 30-day again, which is where that 2,900 level is, then again, don't expect the bounce to occur yet. Not until we see those signs. All right, when you look at the intraday chart, again, we saw this before. We did get a higher high today. We did get a lower low. We gapped down, got to a slightly lower low before coming immediately back up above yesterday's low point, and then filling in the gap pretty quickly too that we had at the open, and then rallying up to just a little bit above yesterday's high, and then testing that for the rest of the day with a small range. So, the range has really come down, from the big ranges that we had the prior days, especially the extreme range that we had on Monday when you included the gap. Yesterday's range was only 4 points, so it was above average. And then today's range also, yesterday's range was only 3.25 points. Today's range was 4 points, so a little bit above the average at 3.5. And the volume at 73 million also right about the average. But keep in mind where those averages are. See, the averages are still relatively low, right? So again, it's when you're above the averages that pulls these lines up, unless it's a really extreme number. Those numbers that are just above the average, those are what pull these lines up and keep them going up. The fact that we're already back down to the averages, again, is another sign that we're not exactly bouncing yet, but we're also not tanking either. Right? If we were tanking, we're going to continue, even on the bullish days, we're going to continue to get the 5 to 6 point ranges with 100 plus million shares traded, even if the ranges aren't necessarily extreme, like we saw on Monday, which happened to be the low point. When we get those extremes, those happen to set the lows, at least the short-term lows. Now let's take a look at the volatility, and you can see the volatility continued down too towards support. There's some support now that we're in the bearish zone for volatility. The 95% is going to act as support, but again, we're not surging here. We didn't get up to 115% like we've seen before, right? So this wasn't a volatility surge. It was just like this one, just got a little bit higher. Towards the 115% mark. So now we're testing right around the 95% level, and there's a good chance that we'll probably trade around here while we're forming this low point towards 95 and 100%. Breaking back below 90% is your sign that we're bouncing and that we're heading back higher again. Most likely would coincide with a break back down below 15 on the actual VIX itself. So pretty good chance that we'll trade between 15 and 20, if not 20, 18, 19 for the next week or two as we continue to try to establish the low point here. All right, so to summarize, just like this bearish move that we've had hasn't been the Armageddon doom and gloom that you might have noticed maybe on financial media. The bounce that we're getting the last couple of days isn't necessarily either, that we're back on the road to 3,000 again on the S&P. So there's still, that there's good technical signs that we're not going to fall apart in the markets. But the technical signs aren't there yet that we're back to a new intermediate run. We're still kind of in that in-between zone where we're not going to fall apart to the downside. There's good support below us, but there's a little bit of resistance ahead of us too. So there's still a good chance for a little bit more time that will kind of show some volatility, some elevated volatility, not extreme, but some elevated volatility, and watch the market here kind of continue to test this low point, a few more times before we get this bounce fully established. So what do you think? Do you agree or disagree with that outlook? There's a poll popping out right there, a link popping out. Click on that link. It opens up a poll. Then hit either agree or disagree. If you vote disagree, scroll to the bottom in the comment section. Let me know what you're seeing that would suggest either maybe you do think we're about to fall apart here because you're seeing something on the charts that suggests that, or some chart you're looking at suggests that this is the bounce, that we have established a low point, we're headed higher again, and we're back on that train to 3,000 sooner than I even think we are. So if that's the case, let me know what you're seeing in the charts, on your charts, or any other factors you're seeing that you would love to share with our market scholars community in the comment section below. All right, now let's take a look at what's driving price action here today, and then our trade idea at the end. You can see, obviously the risk assets were the biggest losers over this 2-week period up until the last couple of days. They've started to bounce, not surprising. Emerging markets still has some room to bounce to recover, and even today they were one of the lowest performing. They really lagged behind, ACWI, whereas the U.S. market outpaced it. But also you see small caps outpace or underperform too the S&P. So this isn't a full-on rally here. In fact, if you just look at just today alone, so we'll go here and go to today and then go to 10-minute chart. You can see that crude oil did rally up the most, but look, for most of the day, long-term bonds were also up pretty high. Along with the S&P 500, and you can see emerging markets lagging behind developed markets. The small cap stocks lagging behind not only large cap stocks but also treasury bonds, and then you can see a high yield also lagging treasury, which is not the most risk on relationship there. So a nice bounce in crude oil. In fact, if you notice at the beginning of the day, we actually had a nice bounce in agricultural commodities. Again, that's your sign, that's your reflection of trade deal, how things are going there, and you notice it pulled back by the end of the day. So we kind of finished right around this 3% level, but that's not nearly as much gains as it had at the beginning when it was the best performing asset class. So maybe a little bit of a reflection that this trade deal odds, as the stock market rallied, trade deal odds, at least with China, right? This wouldn't reflect trade deal expectations with Europe, but more with China there, and you can see a little bit of softening. And that might be one reason why emerging markets was kind of pressured here at the end of the day, and why it didn't rally nearly as much as like the S&P 500 did, and as much as developed markets did, because that seems to be where some of the positive trade data out today seem to come from, was that relationship. Another factor in the risk appetite at play today that we haven't seen the last couple of days is usually the rate cut odds will pull back during any increase in risk appetite. As you notice right now, the odds of a rate cut, this blue, the kind of light blue turquoise line, it can pull back if we get any bounces, but it's continued to stay right around the 70%. In fact, you can see the two rate cuts are at its highest level, kind of matching its highest level, with the one rate cut matching its highest level. So, they haven't broken out yet. We haven't got above that 80% mark, which would break these out and pretty much bake in the cake, this rate cut by the end of the year. So they haven't really broken out of those levels, but you can see, and even the odds of 3 rate cuts are also at their highest level of the past little bit. Not exactly the most risk-on relationship from a Fed futures standpoint. The economic calendar, you can see the biggest news today from an economic standpoint. If you look at retail sales, look at the year-over-year figure, and you can see the trend continues a point lower. We've had a little bit of strength the last couple of months, but since that August peak, we're continuing to trend lower there. The other big one was industrial production and the Empire State Manufacturing. So take a look at the year-over-year figures for industrial production. You can see that trend pointed to the downside. And then finally, the Empire State Manufacturing Survey that was released this morning, it had a nice little bounce back today. So remember, the industrial production is hard data, it's actual numbers. This is survey data, so soft numbers. So survey data tends to turn quicker than the hard data does. So it's that's a good sign. It's only 1 month, but at least it's a good sign that this general weakness that we've had in the economic surprise index may get this bounce established and start working its way higher again. That would actually be positive for yields. Yields are so oversold right now. Those long-term bonds are so overbought. But if you look at the yields, they are so oversold. I don't expect them to get back up to these levels again, where the last time we raised interest rates. But considering how oversold we are, there's plenty of opportunity for it to bounce back towards 2.5%, if not up towards this 2.6, 2.7.5% level again, just to kind of oversold bounce before. Again, the only reason why we'd break through these highs is if the Fed started to consider raising rates again, and that's not going to happen anytime soon, at least. But the Fed's also not going to cut rates anytime soon, unless those numbers break out that I showed you on the Fed futures. That would really start to make this fall towards 2% or less. A softening in those numbers with a return to risk appetite would push this back up into this area too. And of course, you can see that the dollar here is still trading right around this key 97.5 level to establish that breakout or establish it as a fake out there. And again, in a weak yield environment, falling yield environment, that's not necessarily the most bullish for the U.S. dollar. And if we do get a return to risk appetite, and that puts pressure on the dollar from a safe haven standpoint, that could establish the fake out, and then allow some of these really oversold asset classes to bounce back up higher again. If you take a look at these over, say, the last 6 months, and of course the agricultural commodities are struggling the most. They're the most affected by this trade impasse. And you can see over the last little bit, emerging markets have been doing very well with the weakness in the dollar. But since about the middle of April, they've given up a lot of that strength. I mean, if you were just to go from that peak on April the 17th, so it's custom time frame that from April the 17th here, and we'll go on a daily chart to right now. You can see emerging markets have been the biggest underperformer with some recent strength in the dollar. And that strength in the dollar has been more of because of a safety issue. So again, if the risk appetite returns and bonds and gold pulls back and the dollar pulls back too, then you can see which asset class may benefit the most. Remember, they're the ones right now that are struggling the most. If you take a look at how these foreign markets perform today, down the bottom, I mean, these emerging markets continue to be the weakest performers, including Italy in the developed market space. Now, somebody look at that big engulfing pattern in Germany. So these developed markets did really well. Again, that's where the trade chatter came from today. A little bit of a bounce up in some of these emerging markets, China, not so much in India. A little bit of a bounce up in Korea and Russia, and a bounce off the lows in Brazil, but they're still a lot weaker than what we see in these developed spaces, and especially in the U.S. So they're the ones struggling the most with the trade deals. Any kind of return of risk appetite eventually after any kind of short-term weakness would benefit these areas more, especially if the dollar were to break back down and head back down towards that 96 level and pretty much nullify the breakout and make it a fake out. All right, and that pulls us now up to the sector rotation, and not surprising with a little bit of a bounce today. These cyclical areas, communication services, look at that nice little rally back to the moving average. Technology also bouncing back up, still a little bit some room before its moving average, and then these consumer stocks, staples as well as discretionary, all outperforming. On the other end of the spectrum, the lower yields hurt the financial sector. Financials had been bouncing a little bit, but have been continue to pull back more, and then materials, industrials, these dollar-sensitive areas still relatively weak, and utilities, despite the rise, the fall in yields, utilities struggling. So they're unable really to break out. Real estate and utilities unable to break out of the sideways action after a few months of some relative strength that they've had heading into April. In fact, if I were to go to the sector rotation, and let's go back to say a year. Let's go to a year. you can see that utilities over the past year, I mean, look at the double-digit returns for utilities and and staples up there in real estate. Those are these three lines right up here. There, the market's only up 4.5% over a 1-year basis, and those three sectors are getting you double-digit returns, way more than what you're seeing from technology and discretionary. You can see they had the best returns here. If you were to look from, especially if you were to look from about this October, from that October 3rd peak, when the market peaked and we really started to drop to the downside last year, and we went through the lows and back up off these highs. The market's still 2.5% down below that October peak, but not these areas. They continue to show really decent relative strength. And then, of course, as a 3-month, this kind of rolling 3-month window that has been so bullish, they're starting to get back some of their returns, and you're getting these cyclical areas showing better returns. Again, that was a bullish sign for these utilities. In fact, I showed you this chart here before. The last 200 days, you can see that utilities and real estate have been still showing some in staples, still showing some decent returns. Here before, when I showed this, this is like right around the beginning of, you can see, heading into, and you can see the date up here in the top right, heading into really at the end of December, when the markets were at their lowest point. So that's December the 24th right there. When we hit the lowest point, you can see utilities were up 23%. The broad market was down, and utilities were doing really, really well. The broad market was hitting a low, and you can see how bullish it was. And as we fast forward here, you can see those numbers continue to show some strength. And it was, if I go back, let me go back really quick to December 24th. You can see how the biggest losses were in industrials, materials, financial struggled. You can see the discretionary, communication services, technology, and more cyclical areas. Watch what happens to those three over on the left as we continue to bounce off of those lows. We head into February here. We head through March. Get a little bit of a pullback now, or head through April, we peak. Then we start getting a little bit of a pullback now, and those numbers are pulling down. So there's still outperformance in these safe haven areas, underperformance here, and you really got some underperformance in materials and energy. So once we get back to a return of risk appetite, you can see where there could be some outperformance from a sector rotation standpoint. And again, just how bullish we still can be, because we usually don't get significantly bearish, right? If I were to go back to October the 3rd, here is October the 3rd, right before we peaked and started to head down, you can see how bullish the cyclical areas were and how weak the over here the non-cyclical areas. So that was right before we started the pullback. That's more of a bearish sign, and obviously we're not at that point yet. So we're still pretty bullish from that standpoint, from a sector rotation model. All right, so that brings us up for our trade idea of the day. I want to take a look at Humana. You can see Humana's got a nice, interesting price pattern developing. It's been in this healthcare space. Obviously, it's been underperforming despite some relative strength in the sector. But it looks like, a little bit of a double bottom formed here at the 52-week lows, and then a pretty decent engulfing pattern today, engulfing the last couple of weeks. Now, that doesn't necessarily mean that we're going to head higher here and it's on a bearish trend. And remember, again, the markets themselves have been this has been more bearish than the market themselves, but the markets themselves are trying to figure out a low point here. So I don't want to aggressively buy a stock like this with a nice good pattern. You can see from a long-term perspective what Humana looks like. You've got that long lower shadow here on the weekly chart and you can see how bearish the long-term momentum has been. Long lower shadows kind of help establish a low point. And then you look at some other indicators like, the Bollinger Band. Oops, not the linear regression, the Bollinger Bands. You take a look at Humana on the Bollinger Bands, and you can see, that the Bollinger Band low point's trying to establish itself. You can see once you get through, there's some volume up through here to 260, but to get through 260, there's a pretty decent run up to 270. that the stock can make. And if you look at, over the next, between now and June expiration, a move up to 270 is well within the card from a volatility standpoint. So what I want to take a look at is the vertical spreads, and you notice I got different vertical spreads here. But I want to take a look at selling or buying the at the money option, and that's the alternative I have down here at the bottom. You can see if I buy the at the money option, it costs me $860. I have pretty big negative theta and vega working against me, a pretty strong positive vega. But if instead of buying just the 245, if I bought the 245 and sold the 250, now my theta goes down to hardly anything. My delta also goes down, so my risk to the downside, if we do continue to fall, while I'm risking $230, the reality is, if we break through 235, which is where that low point is, this 235 level, if we break through this 235 level, then if we did it today, I'll probably lose about $70, 77 out of that 230, with a potential reward of 270. If we get above 250 and stay above it. That's a pretty decent reward to risk ratio when you count for the fact that we're most likely not going to lose 230. You can see we lose half of it pretty quickly. 115? We can lose 115 pretty quickly. It would take a pretty significant move to do that today, at least. Then the other half, it takes a long time to lose. So kind of the opposite of the short vertical spreads, where we don't have to lose the whole thing. If we lose a lot of it quick, then we'll just move on. Take the loss, knowing that the reward, I can just set in and forget it. So, but if you notice, like I said, you've got that double. This would be a double bottom. You got this top at 260. That would be the target, and of course, it's not a double bottom to actually break through 260. And there's not a lot of resistance up above that. So if if we were to get above 260, and volatility suggests that we could, it wouldn't be a bigger than 1% standard deviation move to do that. Then if you look at the 260, 255 vertical spread, now I'm only risking $141 to make $359. Now remember, I'm not risking the full $149 because I can get down to a $70 loss below that 235 level. I can lose $70, and get to that level, take the loss. You can see to lose the other 70 would take a long time, so I can lose 70 out of that 140. And then now a $70 loss compared to a $360 gain. Again, that's a pretty decent reward to risk ratio, better than 5-to-1 reward to risk ratio if it gets above 260. And you think, okay, well, if I normally risk $500 in this trade, then what I would do is I wouldn't do a full, I wouldn't say, okay, let's do with a stop order at half, let's do $500 worth. No, we would do the number of contracts to get that maximum loss to 500, because we don't want, there we go, 564. We don't, worst case scenario, if this thing just tanks, I know I can't lose more than what I normally would lose, right? It would be $500 if that's a kind of throwing out a round number there. The reality is I probably only lose $280 would be half of that if we got below this 230 level, and we'd cut it off. We'd cut the losses off there, small loss, but for that $280 loss, which would be half of what you would typically lose, what you'd be willing to lose, you could get a reward of $1,400. Like I said, decent reward to risk ratio if you get up to 260. And you can see how a trade like that, it's a speculative trade, expecting a bounce off this hammer pattern there, an engulfing pattern on the double bottom, expecting you to get through this, get up to that level, break through this volume, get up to that 260 level, and then break through a low volume node area to get up to this I don't care how far up it goes, as long as it gets above and stays above 260. So, it's speculative, knowing that if it moves back down below this low point that we had yesterday, then we take a small loss, right? We take a much smaller loss of in this example, $280 compared to what I'm trying to make over $1,400, and a relatively decent probability of getting, a 1 in 4 chance of getting the full $1,400. And you can see in terms of getting just any kind of trade, a 1 in 3 chance, which is typical for that 35% level, 30 to 40% level is typical for a long call. So this is essentially a long call, but with, in my Greeks, a lot less, right? My Greeks end up going, Here we go. My Greeks are down to kind of like an out of the money option. Then I have a very low theta and much less vega than if I did a long call in and of itself. Alright, so that wraps us up for today. Now I want to hear from you. Let's use that link popping out there in the top right corner of your screen that takes you to our Market Outlook forums on marketscholars.com. Open up any new thread you like there with questions or comments about anything we discussed in the video or anything we didn't discuss in the video related to what we've been talking about here. Open up any new thread, reply to anybody else's thread, and let's keep the conversation going in our Market Scholars community before tomorrow's video. As always, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on the video down below. Follow me on Twitter for more content in between videos, and join our community on marketscholars.com as well as the community we created on Facebook. Have a great rest of your evening, everybody, and we'll see you all tomorrow.